Anyway, maybe we'll start off, and where is the remote? Right here. Great. Start off, we like to start off a little bit with some philosophy, and you can read this faster than I can say it. You've seen it a couple of years here, and the background, I think, as you all know, is Mr. Soros is a billionaire that has made his fortune in the markets. He's been a tremendous investor. He's been very astute. And many of you remember he challenged the British pound and that's really one of the things that really made his reputation. But what he's saying here in our minds is that stocks and markets are emotional. The prices tend to react to fear and greed, which we all know. And so what we're really trying to do in our work is recognize that to keep emotion in check and be pragmatic and try to make reasonable decisions. What we've got to always be doing is being careful not to be looking just in one direction. We've got to be thinking about looking at both risk and reward. We're never going to know everything that could go wrong or everything that could go right. But in many cases, if we think about a great business, and we want to start with great businesses wherever possible, and then we try and build a reasonable range of outcomes, that's going to help us to try to be pragmatic about where we're buying stocks and where we're selling stocks. So it's almost like the speedometer on your car. And where are we relative to extreme optimism on that stock versus extreme pessimism? And so in a variety of market environments, it helps us avoid some classic investor pitfalls. And so we try and keep that in mind. When we think about the markets overall, and you ask the question, not that you have, but I'm sure it's on many people's minds, is, should you still be constructive on the outlook for stocks? Well, for sure, we don't have a crystal ball, and it's probably something we'll say a few times tonight, but we'll try and give you a little bit of a flavor of how that philosophy relates to what you've just seen. Last year, we had a different slide, lots of negative headlines since the credit crisis. This year, we refreshed it with some of the things that have been going on in the last couple of years, and you can relate to these various events. And at different times, it felt like the world might come to an end. The Ebola outbreak, I mean, pretty scary stuff. We're not dismissing any of this. It's always possible that this kind of exogenous shock could creep up and really derail markets in the economy. We don't have all the answers. But one of the things we do think is constructive is when there's this sort of constant drumbeat of worry out there, so periodic bouts of bad news that look hard to really assess, it helps keep emotions in check. So when you think about governments around the world today, are they exuberant? Are they overly confident? It doesn't seem that way to us. When you think about businesses, we know they're not overconfident. So it's helping keep their emotions in check. When you think about consumer confidence, this far into a cycle, it's incredible where the consumer confidence levels are. They're ever so slowly creeping up. All of this we think is perhaps good news because it helps keep exuberance from taking over, and that euphoric feeling when valuations really get heady. So we think it's a reasonably constructive backdrop. And this is the update since March 2009, but in this environment of all these negative headlines, any one of which, in some cases could have derailed the market, look what's happened. So it's helpful. When you get in an environment where no one is worried, everyone in this room should be worried. That's what it boils down to in my mind. I used to have a simple metric in Toronto. When I hopped into the cab and the taxi cab driver was giving me his stock picks, then I knew I had to sell. And it's not to say they aren't good, it's just to say everyone's in now. And that's a scary moment in time. So when you think about the economic backdrop, is it still challenging? Yes. For sure. Is it constructive? As you can tell, I'll fault myself for being an optimist. But certainly you could look at the glass as half full, or the pessimistic side. You can say there's all kinds of negative things happening. And certainly debt is a major concern for anybody in this world right now. So we don't take that off the table at any point in time. There's a lot of risk there of that derailing the cycle. No question about it. But when we think about what all the potential negatives are actually doing, well, they're leaving the central banks with the foot to the floor. Stocks, many will say, boy, stocks are quite expensive. Really? with all due respect to my friends in bonds and other things, really? But bonds are, and I don't want to scare you out of bonds, but we've never seen valuations in fixed income like this. We haven't seen valuations in real estate like this. Certainly, you know, it takes you a hell of a long way back before you find anything approaching these kinds of valuation levels. So I'm not saying that everybody should go and mortgage their house and purchase stocks, but from a relative standpoint, it's still a reasonable place to be, and we're still getting positive earnings growth. And if those things can keep sustaining themselves, then we think there's still a reasonable story. The other question that's often thrown up is, well, what about all the pundits claiming this economic cycle is long in the tooth? Well, what you can see on the left-hand side here is they're absolutely right. If you look at the average cycle, it tends to last about 6 years. We often think of a cycle lasting 6 to 7 years, and in fact, that's what this chart tells you. And so we're well on our way in. So the pundits are correct, and yet recall we've been talking about in terms of euphoria, and we're not really seeing that here, and hopefully not for a while yet. And the reason we would think is because there's lots of scar tissue and there's lots of excess, as we're still working our way out of a bubble that we just went through, 2 in a row really in a decade, and a pretty deep recession. And when you look at cycles like that, you can get a much more extended recovery because it just takes more time before you get back to those excesses that tend to kill cycles. Other things could happen. War could break out. Other things could happen. But from an economic perspective, we think the scar tissue of what's happened perhaps is it's hard to bear, but it's somewhat helpful. What about Canada? For sure, there's been some negative news, as we all know, for the Canadian economy. And we've certainly seen it impact the numbers, and we're not suggesting that we're going to see robust growth in Canada or robust inflation. We've got some pressures. But as long as the global economy can keep on moving ahead, we've got a little bit of stimulus, as we all know, from the Canadian dollar. We're getting some stimulus potentially from more U.S. demand on the back of that. And of course, we've had a tiny little bit of stimulus from the Bank of Canada. All of these are potential offsets. So we're not of the view that we're headed for a rough recession here. We are of the view that Canadian growth will be lagging. That doesn't necessarily express what corporate profits will do. The biggest challenge in Canada right now is really in the resource patch. And with that, one of the other questions we would anticipate that's on your mind, and these are all crystal ball questions, really, and we don't have one, but hopefully we can give you some reasonable sense of the way we're trying to approach it. You know, you can think about what's happened with energy. The energy prices have collapsed. Did we anticipate that? Absolutely not. We did not anticipate that we'd see the price of oil down in the $40 range this year. So no question about it. Do we think oil prices could weaken? Yes. So we can't tell you that I know of anybody who can predict oil prices with perfect accuracy. If you meet somebody who has, I'd maybe run in the other direction. But if we think about some of the things that are good about oil relative to other commodities, one of them is it's kind of sad for the world, but it's destroyed when we use it. And another sad reality for all of us who care about the environment is that demand continues to grow. But if you, from a stock market perspective or from an oil price perspective, those factors are reasonable positives. So we've got some excess supply in the world. We know what the politics are now about Saudi Arabia. Well, we've got some excess supply, but you can see it's not a huge excess and demand is growing underneath. So at some point, we expect the market will balance itself. We don't know exactly when. And if you think about what's happening from a supply side to help that, this is one of the factors. This is drilling. There are other factors. So this doesn't tell you that we're out of the woods yet. There are other factors. There are a lot of political factors that have yet to play out, and how Russia responds and Saudi Arabia responds and all these different things. But if you put this together with the marginal cost to produce a barrel, it does suggest that over time we should get back into the $60 to $85 range. And so we think if you think about risk reward in that context, there's some opportunities in the energy patch. What we're really focused on, as you'll see when we discuss the portfolio, is the same thing we've always been focused on. We have a growth-oriented philosophy. And what that really means is what we're trying to do to smooth out the ups and downs in the price of oil is own companies that have a lot of attractive growth opportunity in terms of their production. They can do it very low cost. They're well financed, so they don't have to go to market in really tough times like now and desperately dilute the company's ownership in order to continue to be able to produce. So all of those kinds of factors we're thinking about, and we always have been thinking about. We hope those will steer us through.
So we're going to have a couple more slides here on sort of general market environment. How's it been going? Andrew gave a good kind of recap of some of the factors that are at play and some of the things that we're keeping our eyes on. And so turning ahead, how is that all translated into returns for equities domestically, in the U.S., globally? How is that translated into returns for fixed income assets? So standard market proxies on the page in front of you. We have the MSCI World Index. That's the proxy for the global equities. Top right is the Canadian marketplace, the S&P TSX Composite Index. Bottom left is the S&P 500 Index, so that's U.S. equities. And then on the right is a long title. It changes year after year. It's now called the FTSE TMX Canada Universe Bond Index. And what we see is that it's been, over the last couple of years, steadily increasing equity returns. Equities have far outpaced bonds. And more recently, the Canadian marketplace in particular has suffered relative to its global counterparts. A couple of reasons. Andrew touched on it. There's been an energy collapse, which has certainly affected the S&P TSX Composite Index. It has about a 20% weighting in energy companies, so that's acted as a drag. Secondly, materials-related stocks, gold stocks, base metal commodity stocks, that has also dragged the S&P TSX down a little bit, though over the last 12 months it's still up 7%, quite a strong, attractive return. Looking at our global counterparts, the global equities up 22%, the U.S. equities up 29%. Those are spectacular equity returns. A lot of those have been driven, as I'm sure the discussion which preceded ours mentioned, is the drop in the Canadian dollars by about 13% over the last year. So if you wanted to look at U.S. equity returns in U.S. dollars, it'd be something in the neighborhood of 13%. But lo and behold, we're Canadians, we're Canadian investors, and the U.S. markets in Canadian dollar terms have been doing spectacular, which turns us to the next slide, and we're going to have a look at where those returns come from. We're going to use the S&P 500, so we're going to look at U.S. equities. And what you see in front of you is a return decomposition. So it's a bit dated, we recognize it, but it's a great example of where the returns have been coming from recently, and much of these same drivers are in shape through this year to date as well. So there's a difference between the brown bars and the blue bars. The brown bars are additive to the blue bars. So in terms of earnings growth, which is the first blue bar in front of you, that's EPS growth. You're seeing it's from a balanced components of revenue growth, margin expansion. Companies are involved in unprecedented share buybacks across a variety of sectors, and that's helping drive EPS growth. On top of that, you have a valuation expansion, which is captured in a price to earnings multiple expansion. That brings you your price return, and then on top, you have your dividends. So not only are U.S. companies buying back their stock, they're also increasing their dividends, and it leads you to very attractive total returns. These as well, I believe, are in U.S. dollars, so when we look at them in Canadian dollars, we would probably add another brown bar, and that would be the effect of our currency. Important to note that the market, as Andrew mentioned, it's not euphoric. All of these gains aren't coming from just a price to earnings expansion. It's really coming from a balance of drivers, which we like to see, and leads us to believe that this will be the case going forward as well. So one might ask, given how strong the equity returns have been as of late, how does it look in a historical context? Again, we're going to focus on the U.S. Great data, much longer data. In front of you is a chart going back to the 1950s of the price to earnings ratio for the S&P 500. So U.S. equities, how expensive are they? What's the price that I'm paying for a dollar of earnings of U.S. companies? And what you'll see in the context of a long historical period is that it's more or less at its average right now. It's counterintuitive to think since the tech bubble at the early part of this decade, valuations haven't that they continue to compress rather in the credit crisis. We didn't see valuations really getting too expensive for the credit crisis. No doubt they have certainly started to expand more recently, and that's generated positive returns on U.S. equities, and the same premise holds true for Canadian as well. So certainly, you know, there are periods where the valuation expansion lasts longer than we think, 7 years in the 50s, a 20-year bull run through the 80s, and we're 3 years into the current cycle. So again, touching back on what Andrew mentioned again, is could this cycle be longer? It very well could be. We are now going to dig into portfolio, more specifically into the portfolio, how it's positioned, what sort of activity we've been up to, a bit of a performance recap on some of the main drivers. But before we do that, Andrew's going to just refresh everybody and touch base on our philosophy again with respect to the management of the Tradex equity fund.
Thanks, Graham. So, as you can see, it's challenging in terms of taking a look into the future, but we are still constructive on equities. Regardless, we think there's a number of components of what we're trying to do that'll hopefully continue to work well. And let me just engage you in a few of these. And it's really, I think if you think about what makes us different, it's at least as much for credit to all of you and what you allowed us to do, and your board and your management team at Tradex, as it is to the things that we bring to bear. And I'll try to give you a sense for that as we go through. We are blessed to have a very deep team and a very experienced team, as we understand it. Certainly our Canadian equity team is as deep as they come in Canada. So what's more important is, we'll touch on in a second, is how do we capitalize on that. And I think you'll see it's not just about experience and having as many analysts as you can have, but it's really about how do you ensure that you're leveraging that to make the right kinds of decisions. The growth style in Canada, growth at a reasonable price, is what we're trying to capture in the portfolio. And really what we're trying to think about is companies with good fundamental momentum that we think are reasonably priced, and capture them as early as we can, as we'll touch on. We try as much as, you know, we talk about having some sense for the backdrop and trying to provide you with some sense for how we're putting together a fairly complicated set of global circumstances on a day-to-day basis and thinking about it. The focus really is on bottom-up stock picking. The reason for that is we think it's more repeatable. So as much as we can, you know, all debate the outlook for the markets, for the economy, the reality is what all of us could do perhaps better is get to know management teams, get to know their assets, get to know their business models, and get to know how those businesses are being valued in the market, and try and understand what's being discounted into the stock price and what isn't, and try and make reasonable judgments. We think that's a more repeatable way to build value in the portfolio than taking big bets on being hugely overweight the energy sector in the portfolio or hugely underweight. So we'll take tilts based on our views across the sectors, but we'll primarily focus on bottom-up stock picking. We want to think about owning some of the, as much as we can, some of the undiscovered growth in the Canadian market early. So some of the examples, you know, we've talked about Valiant in the past. We'll talk about Element Financial tonight. We'll talk about Whitecap. So owning some of these great companies that are yet to be discovered by others. We'll talk about owning what's working, which right now is actually, has been in the past few years, owning companies that can do accretive consolidation within their industries. That's one way, great way to leverage on top of a good business that has great organic growth characteristics. And capitalizing on some of the advantages we have given our market position. So positioning ourselves well for new IPOs that are really attractive. One of the things that we can bring to the table is position your fund really well for those. One of those recent examples is Cara, came public. That's the owner of Swiss Chalet and Milestones and many of the restaurants you and your friends probably frequent. It was 23 times oversubscribed, and we were able to get the position size we wanted for this fund. And we're not held hostage to the TSX. The last two, these are really important to the management team and the board in terms of what they bring to the table. We'll hope to use these wisely, but when we are offered the flexibility to go into the United States up to 50% of your investment fund, that allows us to hopefully provide more stability in the returns rather than over the past year, just being exposed to that W, the TSX. You've had 40% of your money down the bottom left. And so we've been able to smooth out the pattern of returns as a result. And one of the other smoothing features doesn't always work to everyone's benefit is tactical hedging. So there is some hedging in the portfolio. Tactical meaning we can take more exposure to the US dollar when we think it's going to appreciate relative to Canada, and take less when we think it's pulling back, such as it did over the past couple of weeks. So the team, I won't go into the details here. You can see there's a tremendous number of people that are involved. The center, if you think of it as a planetary chart here, is really the core of the team. But what they have in terms of their advantage is that this team is focused day in, day out on leading management teams and picking stocks and portfolio management. They aren't actually having to do a whole bunch of the other functions around them. They're not having to find the blocks of stock they need to fill the portfolio. We've got a trading desk that can take advantage of that for them. If they need more insight into a certain sector, they've got a lot of depth to go at. They can talk to a lot of other teams to get things done. And this is just a snapshot of some of those teams that are there, so they can focus their entire job thinking about stocks. If we thought about a stock that would be exemplary, this is a holding in the portfolio. I can't speak to Blair could, but I'm sure he would tell me we didn't own it back in 1996, and we should have. This has probably been one of the most spectacular examples of what equities can do in the global markets in the past 20 years. This company has gone from IPO, split corrected about 20 cents to nearly $50 today. What is it? Many of you might know what it is, but Couche-Tard is the convenience store operator. It's the #2 convenience store operator now in North America. It's also a major convenience store operator in Europe. So it's one of the largest convenience store operators after just starting in our backyard here in Quebec. And this is basically a straightforward business, as you can all imagine. But what it exemplifies some of the things we really like to see. So we've got growing end markets. They're pretty stable. They're not highly cyclical. We've also got a company that's smart, and so they're growing their market share. And they're smart for an additional reason. The third thing that they bring to the table is they've been very effective at being a consolidator in their industry. So they've got a triple play. They've really got three great things going for them. They've got a growing end market, and we can all see more and more corner stores popping up at gas stations, lots of it they own. They're gaining share in it, and they're able to be a consolidator, and in doing so, add on extra earnings. And that's what's driving it. When we think about bottom-up stock picking, we thought maybe we'd bring you our top 5 overweights over the past year in energy, just to give you a sense. And the reason why we chose energy is energy was the focal point of, if you will, sort of destructive returns, very miserable returns in the Canadian stock market over the past year. And we didn't steer clear of all of that news in energy. Having any energy exposure is pretty tough to not have some miserable returns. But in terms of the top 5 overweights, so what made us different relative to the benchmark? Think in the top 5 companies where we had the most significant difference in position relative to the TSX, these are your top 5. And you can see there's only one of these that would be a household name, Suncor Energy. And all of these had pretty good relative performance, which we're pleased with. So that the energy sector over this period fell 14%. So that gives you some sense of what we're trying to achieve. Was the rest of the portfolio, we went through the rest of the portfolio, did we have some stocks that had miserable returns? Absolutely. But the key thing is that where we're taking the most exposure, we're more often than not getting it right. So we're winning in energy. and that was critical last year. An example of the kinds of things you'll see in this, in the company example I'll show you, this is the kind of things we look for, and we've talked about this before, but it's really about finding low-cost producers that are delivering attractive production growth. One example of that is Whitecap Energy, or Whitecap Resources, but it's an energy play, it's a light oil company, and really what makes them very special is they are a low-cost producer. They have a very low decline rate, so their reserves are basically replacing their reserves very, very quickly with successful drilling. And they have a good, healthy production growth. When you have production growth, even if the commodity is moving all over the place, it really helps you steer through the cycle a lot more smoothly and deliver added value for your shareholders. Some of the other things that make us different, and the Tradex team and board have asked us to accentuate in the portfolio, which we really appreciate, is that we have household names in the portfolio. Certainly, we have the Royal Banks, we have TD Banks, we have those household names. But if you really dig into what's driving returns, what's driving our relative positions, or what makes us different in the market in terms of our positioning, it's not a lot of household names. So what we did here is we looked at the top 10 performers held by Tradex last year, and then we've got over on the far right whether they're in the TSX 60. And why the TSX 60? Most major mutual funds in Canada are in this concentrated grouping of large cap companies, and they include the Royal Banks, etc. And so what you can see over on the far left is many companies that some of you may know, but are really not household names, and are not amongst the big large caps in Canada. So the only big household name we would think of as portfolio managers is Brookfield Asset Management, which is a mammoth company that's doing a fabulous job in a lot of areas, including real estate. So many of the buildings you walk into in major cities are owned by Brookfield. The other thing we thought we'd give you an example of is dig into the healthcare sector. It wasn't that far back in my career. The healthcare sector was so miserable in Canada. There was so little healthcare exposure in the Canadian stock market, and so much of it had caused pure misery, that most of our competitors were firing their healthcare analysts or moving them into another role. So they just gave up on the sector. Interestingly, your portfolio is owned over the past year, most times 3 to 5 companies in the healthcare sector. And it goes back a long way. You remember us talking about Valiant last year. This is another one of the companies that we were fortunate the team held in the portfolio, Catamaran. Catamaran was recently taken out. So it was acquired by a major U.S. company, United Health. And Catamaran is essentially in an IT services area for healthcare companies. Has been doing a fabulous job. But the point here is really to be early on in identifying these companies. This company became well known, but when it was put into the portfolio, it wasn't. The same is true for Valiant. And now we'll see. Hopefully the same will be true for Prometric, which is in the portfolio, and others. When I mentioned own what is working, sometimes that means being wise enough to be mindful of the technical signals during the marketplace. It also sometimes means some other things. The number one backdrop to capital markets is that rates are incredibly low. And indeed, it's clear that we used to think rates could go to zero, and then we find out that I think it's about 25% of European debt is trading at negative rates. So time will tell where rates will go. Maybe we'll look back and find that bonds are actually cheap at these prices. But the number one thing from an equity standpoint is if you're not paying much to borrow, if you can put money to work, so take free cash flow to your business, combine it with some borrowings at very low rates, and acquire a competitor, and then find the savings and the synergies. Some unfortunate aspects is we don't know to finding those savings, but the reality is you can build a more efficient business, and for you as shareholders, you can generate pretty attractive earnings growth. So one of the things we spend time thinking about is who are these strong management teams with the right kind of approach that are going to utilize that capital effectively to make what we call accretive acquisitions, smart acquisitions that are going to build shareholder value. These are some of the companies. We don't own every company that's doing this. Everybody's trying this. Lots of companies will make bad decisions. But we think these are some of the companies that will make wise ones. We're increasingly concerned, I will say, about Valiant as it becomes more and more of a household name and a darling stock in Canada. So, don't be surprised if at some point we get more cautious on that. It's done a fabulous job, but it's become an elephant. Believe it or not, it's now the 4th largest company in the Canadian stock market, just behind the top 3 banks. So when we started talking about the stock, it was a small stock. So it's becoming an elephant, so we have to be careful. Element Financial is another example of this in practice. It's actually run by a gentleman who ran Newport Credit, way up and then right into the ground back before the tech bubble. And he learned a lesson in the way he finances companies. And that lesson is now at play in a new version of what he's doing, where he's essentially borrowing capital to lease out, and he's getting the same maturity on both sides of the balance sheet, so the model makes a lot more sense. And he's been able to not only generate attractive organic growth in a financial niche, but also utilize capital wisely from the markets in order to make accretive acquisitions. So Element Financial is an interesting company in that aspect of the portfolio.
Right, so we dug into the Canadian side of the portfolio. I'm going to dig into the U.S. side of the portfolio a bit, give you a flavor for what's going on there. And then we're going to recap the performance, recognizing that we're the last presentation of the evening. Yeah, everybody's getting a little tired, so we'll try to get through it pretty quickly here. What we wanted to share with you, we talked about the overall performance of the U.S. market for the year ending March 2014. And in front of you is the decomposition of the sectors and how they performed over the last year in Canadian dollars. And what you'll see is it's quite spectacular. Healthcare in particular, in Canada and the U.S., was a great driver of performance last year for the portfolio. We're active and identifying opportunities both in the U.S. and in Canada within the healthcare sector. It finds itself at the top of the list there, generating a return of 45%. And interestingly, at the bottom, even the energy sector in Canadian dollar terms was positive for the last year, which is great to see because it was a rough year for energy companies in general. So, great returns, great year, pretty spectacular stuff. It's important to keep this in context. And if you looked at the distribution of calendar year returns going back a number of years, what you'd see is this year in particular is going to be on the right-hand side. It was quite abnormally strong performance. We would caution going forward, given the combination of strong equity returns in U.S. dollars, weakening Canadian dollar, that it's unlikely to see another year of 30% gains south of the border. Though if it happened, it would be a great thing for the portfolio. Does this translate into the exposure of the U.S. equities in the Tradex portfolio? As Andrew mentioned earlier, it has bumped up, and it now finds itself at 40%. Going back to March 2011, we put sort of the calendar year returns in front of you. In the blue bars is the overall weighting of U.S. equities in the portfolio. In the gray bars is the outperformance of U.S. equities over Canadian equities. And two things have been at play. One, it was the active decision a number of years ago to increase the weight to U.S. equities in the portfolio, recognizing that it's a more diversified market. There's a breadth of opportunity. It wasn't going to suffer as much as Canada was, given the resource slowdown. So there was an active decision to increase the weighting in U.S. equities, and at the same time, U.S. equities outperformed Canadian equities for 4 years in a row, as demonstrated by the gray bars, in double-digit returns no less. Back in March 2012, it outperformed Canada by 22%. Lo and behold, the same sort of theme last year, an outperformance of 22%. So it's been a good win for the portfolio overall. Looking at some of the drivers of the returns more recently, the U.S. market, it's a much more diverse market, so you can split it in terms of small caps, mid caps, large caps, across a variety of styles, whether it's growth, value, dividend. And on the chart on the top left-hand side, I apologize, but it's not well labeled. This is the performance in U.S. dollars for the first quarter of 2015 between large cap companies, mid cap companies, and small cap companies, all within the S&P 500. And what we can see is over on the right, the small cap companies have outperformed the large cap companies year to date. And on the bottom part of the page is a table of some of the holdings in the portfolio that have very attractive growth profiles to them. And for those reasons, they are in Tradex's portfolio. And the performance has been quite strong. And it's across a variety of sectors. Infotech, FactSet Research Systems is financial market trading platform and stock quotation platform that we use at work. And Federated National Holdings has been a growing Florida property and casualty insurer. So it's not focused in one particular sector. The small cap exposure within the portfolio is across a diverse number of companies operating in different industries. And it was a good driver of returns for last year, or the last quarter rather. Turning now to stock-specific examples, Spirit Airlines. Spirit Airlines has been in the portfolio for quite some time, going back to the summer of 2012. When we think about the portfolio and we think about investing in stocks with great growth characteristics, it's these types of companies that we're looking to mine within the U.S. marketplace and invest in the portfolio. And given the backdrop of what went on in the aviation industry in the U.S., there used to be 6 major carriers. Lots of them went through bankruptcy through the financial crisis. Out came 3. And so Delta acquired Northwest, United acquired Continental, America acquired U.S. Airways. So you have less players operating at full capacity. And so you had an opportunity for low-cost carriers such as Spirit Airlines, is what they are. They're the lowest cost provider in the U.S. And they do different aviation routes. They have different airports. They fly at off-peak times, which saves them money in terms of costs coming in and out of airports. And so the backdrop was right for Spirit to come into a weak industry that had consolidated, that wasn't growing, that wasn't adding capacity, and be a low-cost provider. So in the top left-hand side, we note that when Spirit was added to the portfolio in 2012, they were going to generate $1.25 in earnings that year. And fast forward to this year, and they're going to earn $1.25 earnings per quarter. And so they've been able to increase their earnings fourfold, while at the same time increasing their fleet, as you can see in the bottom. So they've gone from 54 planes to 80 planes, and they've done that while managing to keep their return on equity stable, which is fantastic because normally as you grow, one of the challenges is to keep that return on equity stable. And so they've been able to do that while growing, while taking advantage of the attractive opportunity in the aviation industry. So Spirit Airlines exemplifies the growth opportunities that we're looking for and do invest in the Tradex portfolio. Turning now, we're going to look at U.S. banks just in terms of a positioning, an area of the portfolio that we're quite excited about going forward. We like the setup, and there's lots of things at play here, but I'll try and keep it short. So what we see is that when I'm talking about U.S. banks, I'm not talking about the larger Citigroup banks or the traditional or historical big banks. I'm talking about the regional players, and these are the opportunities right now in the U.S. banking system. And we're talking about the Bank of the Ozarks. At the bottom, they're a regional player in Arkansas. First Republic Bank Corp is a smaller bank focused in California. And First NPC Bank is a smaller bank, again, focused in New Orleans. And what these 3 companies offer is above average earnings growth, as exemplified in the top left-hand chart. So we can see that overall the bank's earnings are growing at 47% relative to the S&P's earnings, which are growing at 20%. So the banks are doubling the earnings growth that the overall U.S. market is. So that's a good setup. Secondly, they're trading cheaper than the overall index as well, which is what we see on the right-hand side. So this is a great setup in terms of a go-forward. We have franchise leaders within their regional markets. Their momentum in terms of underwriting, mortgage origination, consumer loans is just starting to turn positive. They're not as heavily regulated as some of the larger banks would be now coming out of the financial crisis, so they have a bit more flexibility in terms of their operations. They have attractive growth rates, and they're also attractively priced right here in the current marketplace. So overall, that's an area of the portfolio that we're quite excited about going forward. And we're going to wrap it up with performance. We hope we've given you a flavor of how it all comes together, and how it all comes together is in the performance over near term as well as the longer term, which Andrew will touch on, and we'll go with questions.
Okay, so from a performance standpoint, I think there's really two comments. One is that this is really the combination of everything we talked about, and so when you look at the 5-year performance, it's the combination of having the flexibility to try to own the growth opportunities in the Canadian stock market and get a good representation of the Canadian stock market, and marry that with the U.S. equities when we think it's attractive to do so. So it's, the benchmark is the S&P TSX, but to be fair in representing it to you, recall that we can, we have up to 40% exposure right now. We were recently given a couple of years ago the opportunity to go beyond 35. We've taken advantage of that, so that we've been benefiting from the boost and the exceptional outperformance we've seen in the U.S. equity market. So relative to the benchmark, it's really a combination of stock picking, adding value, and also thankfully making a good decision in terms of both the board of Tradex and ourselves in building that U.S. exposure to try to keep some strong top-line performance in the portfolio. Whoopsie. Wrong button. And then our last slide is just giving you a sense. So the peers, the peer group we're in, has the opportunity to go up to 50% foreign stocks. So this gives you a sense. When you look up the Tradex Equity Fund on Globe Funds and see that peer group, they also have the opportunity to do this. So we're not alone. And in fact, we only could go to 35% before the peer group could go to 50. So this gives you a sense of, are we making hopefully good judgments overall? And be mindful, this is an industry where batting average is good, is better than 55%. So are we generally making some pretty good decisions, and are we doing so better than our competitors who have the same types of flexibility that we have? And that hopefully gives you some sense of the report card there. So that's all we have to say this evening, other than thank you so much for your ongoing confidence in our abilities. The whole team takes it very, very seriously, and I know they would all say thank you very much on behalf of us for continuing to trust us to steward your precious capital. We take it very seriously. Thank you.
Is there any questions? We have time for a couple of questions.
At what point did you require a push card?
It's a great question. Why don't we look back and we'll send it to Blair. And then he can forward it to you. Because actually tonight I think we were talking about that on the way here. We were trying to recall, so I can't give you the precise date.
Was it a few months past, or?
No, it's been in the portfolio for a while, so I think it's been in for a couple of years, but it has not been in. So Tradex Equity Fund should have owned it the entire way through. If we had recognized it earlier on, that would have been ideal.
Why did you buy Activist? The newsletter said you did, I think.
You want to speak to that?
Yes, no, that's correct. Activist was acquired Valiant after, acquired Allergan after Valiant did. So given the winner of that suit, it went back and forth between Allergan and Valiant for a number of months. Obviously, it's an attractive company going forward. They had a leading position within that generic Botox treatment that they were working on, and likely going forward, it will be a good holding within the healthcare sector portfolio.
Maybe one other piece of information that's relevant, which is that one of the caution flags we have on Valiant, if you will, that we're being mindful of, is that there are now a number of copycats. So there's a number of other companies that are realizing the healthcare space is ripe for consolidation, and Activist is one of those, and it's another successful version of the same kind of business model as Valiant. And so there's a little bit of diversification in that. We think it's an attractive way to get healthcare exposure with smart consolidators, but we're mindful of the opportunity to try to diversify that exposure in the portfolio.
Does your analysis process address in evaluating companies address all their vulnerability to information security threats? For example, the impact on, say, Target and Home Depot in the last year, and also the threat to possible disruption to utilities or through the control systems like that?
So the short answer to your question is no, not to the degree of sophistication where we can sort of score companies based on all those kinds of characteristics. And so your question is a good one from the standpoint, does it affect business models? Absolutely. What we're trying to do is to measure the capability of management to hire the right people to make those decisions and to assess them correctly. And there's no question you can have really smart management teams get that wrong, but it's right now we haven't identified a really good way to go in and practically understand all the security systems, because if you think about it, most companies aren't going to let everybody know what all their security protocol is. So it's really something that would be very difficult for us to assess because of the confidentiality around it. But it's a good area to be thinking about.
Historically, one of the problems has been, at least in some companies, they appear to have taken the view that they would accept the risk as a cost of doing business.
Yes, that's fair. What we're constantly thinking about is some of those types of issues, and they boil down to one of the things we care about a lot as well, which is really good governance. So the kind of people that are overseeing all the kinds of decisions you need to be thinking about, from accounting to standards on security across a company.
I see your top 10 holdings you have as number 3 CN.
Yes.
I'm wondering whether you missed CP or was that just you ignored it?
It's actually, in fact, we were talking about it today in the board meeting. I was saying one of the most amazing things that's happened is that CP has now got an industry best margin in the railways, and yet even at our firm, the thought was that the CP network would have difficulty becoming the highest operating margin network in North America. And Hunter Harrison and his team have managed to do that in very short order. So no question, we have been surprised if we're thinking about that speedometer. The actual bull scenario at the top end of the speedometer was reached faster and went far beyond what our expectations were. So we owned it and sold it and have a big position in CN. Could we have, CN's done great for the portfolio, but could we have that decision again today with all the facts that are on the table? We should have not owned CN and just owned CP. And kept a really big overweight in CP instead.
Are you going back into CP or looking at it again?
Constantly. So what we're concerned about is the same thing. Do we have all the good news baked into the stock? And we keep getting it wrong. There's still more to come.
What about Canadian banks? They tend to be a high, like your two major holdings of Canadian banks, I think. Like, what do you see? A number of people, I've had a rumor around, from what I read, a number of people think they're pretty fully valued. Or, like, are you maintaining the same percentage in the portfolio of banks, Canadian banks, or are you doing it, or
Great question, and I think it's probably one that interests everybody in the room. I'm sure many of you would hold bank stocks independently. We think it's a good time to own the Canadian banks, and we've actually added to our positions in the Canadian banks in the recent months because they were pulled down. They were sort of tarred with the energy crush, if you will. So there was a lot of concern about consumer debt in Alberta, that could hurt the Canadian banks. There was lots of concern about energy loans, and there was all these different concerns that were thrown at the banks that added on to the overarching concern that you see globally about Canadian household debt and all these other issues and the Canadian dollar falling out of bed. So there was a lot of shorting activity coming out of the U.S., particularly U.S. hedge funds. Blair was talking about this today. You can see it in the borrowing figures that are there for Canadian bank holdings. But what happens when people are shorting is they're borrowing the stock and selling it, as many of you know, and they're betting the stock price will fall so they can buy it back at a lower price. And what that meant is it pressured multiples down to very reasonable valuations, 10 to 11 times earnings. Do we think the Canadian banks have supercharged earnings growth? No, we don't really need to bet on that. But we do think they offer a very diverse set of earnings streams, a lot of very recurring revenues. Businesses such as ours and in asset management are fabulous. And so what we're really looking for is single-digit growth, dividends to continue to get elevated, and in combination you've got a good total return package, and when you're buying it at 10 to 11 times earnings, you've got the potential for the multiple to rise too. So we do think, relative to what's out there in the Canadian stock market, they're attractive right now, and our favorites are Royal, TD, and Bank of Nova Scotia.
What about Apple? Apple is about 15% of my shares. Do you have it as one of your stocks, or you don't like it?
It's our number one holding in the U.S., and it has been now for 2 or 3 years. But I would say, I would acknowledge to you there again, we wish, as much as we're trying to do early identification of growth, we wish we'd owned it a long time before we did in the U.S. side of the portfolio. We do like it. At some point, we all know that the law of large numbers is going to affect Apple, but they still seem to be a lot of ingenuity there in terms of inventing new products and continuing to find ways to grow. And they are just getting started, it seems, in essentially building a lot of different annuity streams, trying to become the next cable and telco companies. And so we think there's a lot of potential. Unfortunately, we're all hooked onto Apple, and they slowly hook us, and then they start finding ways to charge us, such as the cloud. They gave us all these great devices for storage, and then what did they do? They shut out the storage in the devices, took the hard drives, cut them back in size, and then said, you can buy it on the cloud monthly from us. So it's a juggernaut business, and it's very difficult to forecast, but the ingenuity, the culture of the company, the execution, the products, those are all things that give us good confidence still that this company hasn't lost its way and there's still a healthy future ahead.
They're also seeing incredible demand growth out of China still, and perhaps just in the early stages of that. And what becomes of the Watch project that they're embarking on provides some good optionality in terms of earnings going forward as well. And the most recent set of earnings was actually the second best set of earnings that the company's ever released. So in terms of identifying a slowdown in earnings, it doesn't seem to be the case. Could their earnings slow if they stumble upon the Watch release? And the iPad sales volumes are certainly slowing a little bit, but in terms of earnings, they're still delivering spectacular earnings.
Yes.
Can you provide some comment on Google? It doesn't seem to be moving very much, and I see that you have a position in our portfolio.
Absolutely. So, yeah, Google's had some spectacular years, and last year wasn't its best. I think it was up in the range of sort of 14% in that kind of range, so it was not a leader in the U.S. market. There again, it would be very similar comments to what we highlighted on Apple. Again, they're finding all kinds of new revenue opportunities because they become the juggernaut in their space. And so we recognize that there's a number of those kinds of companies that really represent a lot of the things we want to own. Good fundamental momentum because they're in growing market segments, they're industry leaders that are gaining share, and they're finding new avenues with ingenuity for their growth. The interesting thing about both those companies that I'm leaving you with as a theme is that They are technology companies, they are software companies, they are many things, but they're also quickly becoming network companies that are collecting annuity streams from all of us on monthly, weekly basis for doing a whole bunch of services we expect to do. I can tell you that the Canadian banks are concerned about what Apple may represent within the payments industry. So there's a lot of different places these companies are looking to expand, and a lot of valuable real estate where they present a real threat.
Just one more question. Facebook. What do you think there?
Facebook is as Graham said, is not in the portfolio, and the reason for that is it does represent some of the other comments we've made, but it's in our minds has been it's very expensive, and it's not as clear that all that ingenuity is going to be easy to monetize over a very long runway, as we see for Apple and Google. Apple and Google are much less expensive, and we see lots of opportunities for monetization. So Facebook, as we all know, runs into lots of different issues around privacy as it's trying to monetize all those users.
Thanks.
Thank you, Andy. Thank you, Graham. We'll now pass on to the official business part of the meeting. So